Usually when you look at a financial terminal, you're watching the pulse of corporate America.
Right, yeah.
You see all those numbers flashing red and green, and you just know those figures represent like iPhones sold or cars manufactured or maybe the fluctuating price of a barrel of crude oil. It's very clinical.
Totally. It's detached.
Exactly, detached. But imagine looking at that exact same screen, watching the numbers update in real time, and realizing you aren't looking at corporate earnings at all. You're looking at the literal quantified odds of a ground war.
Yeah, which just fundamentally changes your relationship with the data on the screen. I mean, the metrics are no longer about profit and loss in some commercial vacuum. You're basically watching a live ticker of global stability.
And that brings us to our mission for this deep dive. We are examining a really fascinating, highly analytical article published on June 20th, 2026. It's titled, Will the U.S. Invade Iran? Odds Analysis for Leverage Traders.
It's a heavy topic, yeah.
It is. We're going to explore how financial prediction markets, specifically a platform called Polymarket, are attempting to quantify the odds of war and peace. And, we'll look at the mechanics of how leveraged traders are actually betting on global crises.
Right.
But before we get into the weeds, it is really important to state right up front to you listening that we are dealing with highly sensitive, politically charged geopolitical events involving the United States and Iran.
Very sensitive, yes.
So we need to be clear. We aren't taking any political sides here. We're not endorsing any diplomatic or military actions mentioned. Our focus is strictly on analyzing the facts, the market mechanics, and the data exactly as presented in the source text, completely impartially.
And that analytical distance is crucial, really, because the mechanics of these markets are complex enough on their own. I mean, we're observing a relatively new financial system that tries to absorb human volatility.
Right, like diplomacy, military posturing, political rhetoric.
Exactly. It takes all of that and tries to distill it into cold, actionable mathematics.
And the mathematics we're looking at are just staggering. I mean, we're tracking a specific prediction market asking whether the U.S. will invade Iran by December 31st, 2026. And this specific market recently experienced one of the most violent, dramatic reversals in trading history.
It really did.
Okay, let's unpack this. To really grasp what's happening right now, we have to look at the exact parameters of the bet.
Yeah, because the contract language on Polymarket is incredibly strict. It resolves to yes. Only if U.S. military forces commence a ground invasion of Iranian territory by 11:59 p.m. Eastern Time on December 31st, 2026.
A ground invasion specifically.
Right, exactly. Any other outcome, airstrikes alone, naval engagements, or a peaceful resolution, means the market resolves to no. And right now, the odds set at 86.5% for no and just 13.5% for yes.
But those numbers only tell the end of the story. I mean, to understand why traders are behaving the way they are today, we really have to rewind to the spring, because you can't comprehend the financial swings without looking at the real-world events driving them.
No, you can't.
In May of 2026, that yes contract was definitely not sitting at a quiet 13.5%.
Not even close, no. In May, the yes contract was trading between 55 and 65%.
Wow.
Yeah, the market was pricing a ground war as the probable outcome. This was the direct fallout from what the source documents referred to as Operation Epic Fury.
Right. On February 28, the U.S. launched targeted strikes against Iranian nuclear and military infrastructure. And the ripple effects across the globe were, well, they were immediate.
Absolutely. The source points out that tensions hit their highest point since 1979. We saw naval blockades choking the Strait of Hormuz.
Which is a massive bottleneck for global energy supplies, right?
Huge. Oil futures spiked toward $150 per barrel. So for the traders looking at these boards, the invasion question had shifted from this theoretical geopolitical exercise into an imminent operational reality.
And the capital just flowed toward that sentiment, didn't it?
Oh, massively. During the peak of that air campaign, an astonishing $529 million was traded on strike-related prediction markets.
$500 million.
$500 million changing hands as people tried to hedge or speculate on the escalation.
And then the pressure valve suddenly released. June 19th arrives, bringing the Burgenstock MOU signing ceremony. U.S. Vice President J.D. Vance and Iranian Parliament Speaker Mohammad Bagher Ghalibaf met at a Swiss resort.
The same location historically used for Ukraine peace discussions.
Right. And they formalized a 60-day framework for a permanent ceasefire and nuclear talks.
And the market reaction to that handshake was instantaneous. I mean, traders immediately repriced the probability of a ground invasion. The yes contract suffered a 75% collapse in value in less than 2 weeks.
That is wild.
It is. A diplomatic off-ramp had appeared, so it transformed the sentiment from a crisis-level probability back to, a normalized state of geopolitical friction.
Think about the traders who held their nerve through that escalation, though. The ones who looked at the naval blockades and the airstrikes and still bought the no contract, betting that diplomacy would eventually prevail.
Oh, they made out incredibly well.
Yeah, when the odds jumped from around 40% to 86.5% following the Swiss meeting, that yielded a gain of over 116% on their underlying position.
Which, 116% return is a career-making year in traditional equities, but in the ecosystem of prediction markets, it merely sets the baseline for the volatility we're discussing.
Which leaves us with a really compelling mystery. So what does this all mean? We have this historic diplomatic off-ramp, high-level officials shaking hands in the Swiss Alps committing to a framework.
All right.
The natural assumption for anyone watching the evening news is that the crisis is averted, the war is off. So why is the market still pricing in a 13.5% chance of an invasion? I have to wonder, is that number just statistical residual noise, like a quirk in the trading algorithm? Or is the market signaling a legitimate threat that this diplomatic victory might unravel?
What's fascinating here is that the 13.5% is absolutely not algorithmic noise. It represents a highly calculated risk based on physical realities on the ground that traders simply cannot ignore.
Physical realities like what?
Chief among them are the literal stockpiles of material. According to the source data, Iran currently holds 440.9 kilograms of 60% enriched uranium.
Let's pause on that 60% figure for a second. Because the enrichment scale isn't linear, right?
No, not at all.
Getting uranium to 60% enrichment requires the vast majority of the technical effort and time. Moving from 60% to 90%, which is weapons grade, is comparatively fast.
That is the crucial context, yes.
Yeah.
They're one short technical step away from a nuclear weapon. The physical threat hasn't been dismantled by the MOU. It's basically just been paused.
Right.
And then you have to evaluate the timeline that diplomats have given themselves. The Burgenstock framework allocates a mere 60 days to reach a comprehensive nuclear agreement.
Which just seems wildly optimistic when you look at the historical precedent.
Exactly. Former lead negotiator Wendy Sherman, alongside several independent analysts, has publicly stated that 60 days is practically insufficient. To provide a benchmark, the original JCPOA, the Iran nuclear deal negotiated under the Obama administration, that took 18 months of grueling diplomacy to finalize.
18 months. So a 60-day window is the equivalent of trying to negotiate a 1,000-page, incredibly complex corporate merger over a single weekend.
Pretty much.
And not just an ordinary merger, but one where the two executive teams actively distrust each other and have heavily armed security details staring each other down across the table.
That's a great way to put it. The prediction market is essentially saying, well, the handshake in Switzerland was great, but the logistical odds of actually drafting and verifying this paperwork in 60 days without hardliners on either side sabotaging the talks. We price the risk of failure at 13.5%.
The market doesn't trade on optimism.
No, it doesn't. The 13.5% is the cold probability that diplomacy stalls, talks collapse, and the military option becomes the primary reality again before December 31st.
Okay, so understanding that the risk of diplomatic failure is very real is one thing. But how sophisticated traders monetize that uncertainty? Here's where it gets really interesting.
It does get very dense here.
Yeah, we're shifting from political science to the raw mathematics of margin trading. The source article focuses heavily on the concept of convexity.
Right, convexity.
To visualize convexity, think about the math of a long shot. If a stock is trading at $100 and goes up $16, you made a 16% return. That's a solid day. But if a prediction contract is priced at 13.5 cents, representing a 13.5% probability, and it moves to 30 cents, that same roughly 16-point bump represents a 122% gain on your money.
Because you're starting from such a low base, yeah. The percentage yields are asymmetrical. The upside is mathematically immense compared to the initial capital required.
But traders on platforms like Predmart.com don't stop there. They apply leverage. The source notes they can use up to 5x leverage on these geopolitical events.
Yeah.
So if you apply 5x leverage to that 122% gain, you are suddenly looking at a massive 600% return just from the odds moving from 13.5% to 30%. But I have to push back on the strategy, though. Applying 5x leverage to something as inherently unpredictable as Middle Eastern diplomacy seems like financial suicide.
It's certainly aggressive.
Right. Because if you're holding a leveraged long position on the yes contract and the peace talks go well, causing the odds to drop from 13.5% down to 3%, you don't just lose a little money.
Yeah.
At 5x leverage, a drop like that completely wipes out your position. You are liquidated.
If we connect this to the bigger picture, you would be liquidated, yes.
Hmm.
But to understand why traders take this risk, we have to look at how prediction markets differ from traditional options markets.
Okay, how so?
Well, in traditional finance, if you buy an option on a stock, it suffers from theta burn, which is time decay. You can think of a traditional option like a melting ice cube.
A melting ice cube.
Right. The longer you hold it, the less it's worth as the expiration date approaches, unless the underlying stock makes a massive move in your direction. You are constantly bleeding value just by waiting.
You're paying a penalty for time.
Precisely. But polymarket contracts do not have theta burn. The ice cube doesn't melt.
Oh, wow.
Yeah, the contract simply resolves to 0 or 1 at the deadline. If you hold a no contract at 86.5% all the way until December 31st, and the U.S. does not invade, you receive the full 100% payout. Because there is no time penalty, traders use a strategy called position sizing discipline.
Walk us through how that actually works in practice.
It means that they don't treat that 13.5% yes contract as a directional conviction that war will definitely happen. Instead, they treat it as an asymmetrical portfolio hedge. Because the contract is so cheap and the leveraged upside is 600%, they only allocate an amount of capital they are fully prepared to see go to zero. Their maximum position size never exceeds their worst-case drawdown tolerance. So if diplomacy succeeds and the contract expires worthless, they lose a tiny fraction of their portfolio. But if talks collapse in August, that tiny fraction pays out sixfold.
Okay, but what about the traders on the other side, the ones holding the no contracts and betting on peace?
Their risk profile is completely different. Their worst-case scenario isn't the contract expiring at 0 immediately, but they face severe liquidation risk along the way. Imagine the talks hit a sudden snag. The no odds might drop from 86.5% down to 50%.
Right, because of the bad news.
Exactly. That is a 30-point adverse move. If a trader is heavily leveraged on no, that sudden drop in the asset's value will trigger a margin call. The broker will demand more cash to cover the position, and if the trader doesn't have it, their position is automatically sold off at a massive loss.
Even if the war never actually happens.
Exactly. Even if peace ultimately prevails in December, the trader was wiped out in August because they couldn't survive the volatility. So no traders must maintain a substantial margin buffer, uninvested cash sitting in their accounts, just to survive the natural turbulence of diplomatic negotiations.
Framing diplomacy as financial turbulence that requires a cash buffer is just a wild concept. It highlights a core premise from the source, though. Traders do not bet on the final resolution. They bet on the friction points along the way.
They trade into catalysts, yes.
Yeah, the article outlines a specific calendar of these friction points. The market isn't just staring blankly at December 31st. They are watching a series of cascading dominoes, where each date forces the market to aggressively reprice the odds. Let's walk through those.
Okay. The first of those dominoes was June 30, which tracked a polymarket contract on whether a U.S.-Iran nuclear deal would be reached by that date. That market was trading at a very low 18%.
Which aligns perfectly with the Wendy Sherman precedent we discussed. The market correctly viewed a comprehensive, finalized nuclear agreement within a few weeks of the initial handshake as practically impossible, especially given the complexities of verifying uranium enrichment caps.
That was the easy hurdle to predict, yeah. The much harder test is the physical bottleneck on July 15. This marks the 30-day deadline for the Strait of Hormuz reopening. Essentially, it's the deadline for lifting the naval blockades. The market prices the odds of this successful reopening at 85%.
That implies the market strongly expects it to happen, but leaves a 15% window for failure. Where is that 15% coming from?
It comes down to execution risk. You are dealing with heavily armed, highly suspicious military forces that have been operating on a hair trigger for months. They now have to perfectly coordinate a mutual disengagement in one of the most congested waterways on the planet.
Sounds incredibly tense.
Very. The margin for error is razor thin. A single miscommunication like an Iranian speedboat aggressively approaching a U.S. destroyer or the discovery of a stray naval mine in the commercial shipping lanes would instantly swing the overall invasion odds 10 to 15 points.
Wow, one misunderstanding on the water and leveraged traders globally are facing margin calls.
Exactly.
Assuming they navigate that physical disengagement, what is the next pressure point?
We move into late summer There's a secondary contract tracking whether the ceasefire holds through August, which is currently trading at 72%. But the critical date is August 17. That marks the exact end of the 60-day nuclear negotiation framework established in Switzerland.
The end of the diplomatic runway.
Correct. Now, the MOU does allow for an extension if both parties agree, so it isn't necessarily a hard cliff where war begins on day 61. However, if August 17 passes without a formal extension or a concrete agreement, the baseline yes invasion odds will not remain at 13.5%.
Shoot up.
Oh, yeah. The market will immediately reprice that failure, and we would likely see the odds spike rapidly toward 25 or 30%. That specific date is the clearest window for leveraged traders to capture the convexity you mentioned earlier.
And even if the diplomats manage to secure an extension and push the timeline into the fall, the calendar presents a massive domestic hurdle on November 3, the U.S. midterm elections.
Analysts consider this a second-order catalyst. The midterms do not change the physical reality of the uranium stockpiles in Iran, nor do they change the naval positions in the Strait. But they completely rewrite the political calculus in Washington.
Right.
If we see a sweeping Republican victory, it could embolden a more hawkish military posture. Conversely, significant Democratic gains might reinforce the current administration's diplomatic mandate. Regardless of the actual situation in the Middle East, the uncertainty of election week is mathematically guaranteed to inject 5 to 10 points of volatility into the polymarket boards.
So the traders are essentially forced to price in the American voter as a geopolitical risk factor?
Exactly.
Finally, we reach December 31st, 2026, Resolution Day. If no ground invasion has commenced by 11:59 p.m. Eastern Time, the yes contract mathematically decays to 0, and the no contract holders collect their payouts.
Though the source document astutely points out that the final quarter of the year is uniquely dangerous for traders.
Oh, really?
Yeah, if negotiations break down in October or November, it creates a massive final volatility spike. Traders have to frantically reassess whether the logistical window for a military operation is still viable before the New Year's Eve buzzer.
Synthesizing all of these moving parts, the core takeaway from the analysis is pretty clear. The easy money on the no side has already been made.
Definitely.
The traders who captured those massive 116% returns did so by holding through the darkest days of the spring escalation, catching in on the historic Swiss MOU. Now, the market on platforms like Predmart.com, with their 5x leverage options, has transformed into a high-stakes waiting game.
It really has.
It's an exercise in navigating execution risks, the Strait reopening, the August deadline, the November elections, while managing severe drawdown risk and waiting to see which side blinks first.
This raises an important question, though. Why should anyone outside of the financial sector care about the complex mathematics of leverage traders?
That's a fair question.
The answer is that these prediction markets serve as an unparalleled real-time barometer for world peace. We are constantly subjected to political rhetoric, diplomatic spin, and media narratives. Prediction markets cut through the noise. They reveal exactly what individuals with real capital on the line, people who face financial ruin if their analysis is incorrect, genuinely believe is going to happen. It's a system built entirely on incentivized accuracy rather than political posturing.
It functions as the ultimate financial truth serum. But reflecting on everything we have covered, it leaves us with a provocative, somewhat unsettling reality to consider. We began this discussion by comparing the prediction market to a standard corporate stock ticker, a clinical screen of red and green percentages. But the underlying asset here is human conflict. We are living in an era where anyone with a brokerage account and an internet connection can log on and trade the exact probabilities of a global crisis, applying up to 5x leverage to the outcome. So here is something for you to mull over. Does the financialization of geopolitics make us more clear-eyed and analytical about the true state of world peace? Or does turning the threat of war into a tradable asset class make us dangerously detached from the human realities on the ground? It is a question worth turning over in your mind the next time you see those numbers fluctuating on the screen.